Welcome to Cashflow 9, where we turn smart moves into unstoppable money. Smash that like button and hit subscribe to join the Cashflow crew. You're 45 now, it's a random Tuesday and a quiet house, glass of wine on the table. You pull out your checkbook like some kind of old school cowboy banker, and with one final dramatic signature, you write a check for $42,000. The last of everything you've got. But damn, it feels good. You just killed the mortgage. You slap that check in an envelope, send it off. And for the first time ever, you sleep like a baby. No house payments. No bank. You own your castle? In your head, you're the responsible adult the world told you to be. You're debt-free. You're a hero in your own financial movie. But fast forward 6 months, and the plot flips like a cheap lawn chair. Your job evaporates. Industry tanks. Income zero. You check your bank account and it coughs dust empty. Why? Because you just shoveled every liquid dollar you had into the walls you live in. You're sitting inside a $500,000 box of trapped equity. But you can't grocery shop with drywall. You can't pay the mechanic with a brick. You go back to the same bank you just gifted 42 grand to and say, "Hey, could I maybe get a home equity line?" And they look at you like you're the funniest sitcom of the year. No job, no credit income. Sorry buddy, we don't lend to people who actually need money. Now your house rich, cash poor, and stress eating cereal for dinner. This is the liquidity trap. Debt-free felt safe, but it mathematically made you fragile. See, paying off a mortgage early scratches some ancient emotional itch from our grandparents' era. Back when interest rates were double-digit and inflation was a monster hiding under the bed. Back then, killing debt via survival. A 14% mortgage. Paying it off is a guaranteed 14% return. Easy math? No, brainer, but today, whole different universe. You pay extra principal on a 3-5% mortgage, and that's basically like locking money in a low-yield savings account with a concrete withdrawal penalty. Would you ever voluntarily invest in a savings account that pays 3% A&D, won't let you touch the no shot? But that's exactly what early mortgage payoff is. Now comes the spicy part, arbitrage. This is how banks get rich. They borrow money from you at 0.5% and lend it back to you at 6%. The spread is their profit. You can flip the same play. Got a 4% mortgage and can invest at 80%? That 4% gap is your profit, created by leverage, not sweat. But when you rush to pay off the house early, you're firing your most productive financial employee. Leverage. And here's where risk gets twisted. Most people define risk as owing money. But real risk is not having access to money. Extra payments kill liquidity. Equity doesn't buy groceries. Equity doesn't keep the lights on. Equity is dead money until you borrow or sell. And banks only lend to people who don't need it. Who's safer? The person with the paid-off house and zero cash, or the person with the mortgage and $500,000 liquid in a brokerage? Not even close. Liquidity is survival. Liquidity is options. Liquidity buys time, and time is how wealth compounds. Pay off the mortgage early and you don't gain freedom, you gain a trophy. But a trophy doesn't pay the bills. Now inflation enters the chat. A fixed 30-year mortgage is inflation's punching bag. Your payment stays the same, but the money you're paying with gets weaker every year. By year 20, that $2,000 month feels like $800 in today's dollars. Inflation is silently paying half the loan for you. But if you pay it off early, you lose that gift. Never pay a bank with valuable dollars today if you can pay with worthless dollars tomorrow. Opportunity cost is the invisible millionaire. Pay an extra 1 KEET month for 15 years and you feel virtuous. Invest that same 1 KEET month into the S&P and you might be staring at 400K in 15 years and nearly 2 million in 30. Meanwhile, the irresponsible, debt-free heroines with a house and no army of investments. A paid-off house is a trophy. A portfolio is an army. I'll take the army. So here's the play. Stop throwing extra cash at the mortgage. Open a brokerage account. Auto-invest the difference. Let liquidity be your moat. Let inflation work for you, not against you. Let leverage do the heavy lifting. Debt isn't sin. Debt is a tool. Absence of liquidity is the real danger.